Response 1 of 3, Terms 135. Part 1. Core Finance, Valuation and Macro Mechanics. 1. Internal Rate of Return, IRR. The definition: the metric used in capital budgeting to estimate the profitability of potential investments. It is the specific discount rate that makes the net present value (NPV) of all cash flows from a particular project equal to zero. The real explanation: think of IRR as the break-even interest rate for a project. If you are deciding between building a new factory or investing in the stock market, IRR tells you the annualized percentage return the factory is expected to generate. If the factory's IRR is 15% and your cost of borrowing money from the bank is only 5%, the project is a green light. However, IRR has a major flaw. It assumes that any cash generated by the project is reinvested at that same high rate, example, 15%, which is often unrealistic in the real world. Context: venture capitalists use this to argue that a startup will yield a 40% return year over year, helping them compare it against safer bonds. 2. Net present value, NPV. The definition: the difference between the present value of cash inflows and the present value of cash outflows over a period of time. The real explanation: money today is worth more than money tomorrow due to inflation and opportunity cost. NPV takes all the future money a project will make and discounts it back to what it is worth today. If you invest $100 today to make $110 in 5 years, that might look like a profit, but if inflation is 3% a year, you actually lost value. NPV accounts for this. If the NPV is positive, greater than $0, the investment adds value. If negative, it destroys value. Context: it is widely considered superior to IRR because it deals in absolute dollar amounts rather than percentages, giving a clearer picture of total wealth creation. 3. Weighted Average Cost of Capital, WACC. The definition: a calculation of a firm's cost of capital in which each category of capital is proportionately weighted. The real explanation: companies get money from two main sources: debt, borrowing, and equity, selling shares. Lenders demand interest, cost of debt, and shareholders demand growth or dividends, cost of equity. WACC is the average cost of all this money blended together. If a company's WACC is 8%, it must find projects that return more than 8%. If they invest in a project returning only 5%, they are technically losing money for their investors, even if the project is profitable on paper. Context: this is the hurdle rate that CEOs fear. If they can't beat the WACC, their stock price usually tanks. 4. EBITDA, earnings before interest, taxes, depreciation, and amortization. The definition: an alternate measure of profitability to net income. The real explanation: net income is the bottom line, but it can be distorted by tax loopholes, one-time interest payments, or accounting decisions like depreciation. EBITDA strips all that away to show the raw operating power of a business. It asks, is the core activity of selling this product profitable? Context: private equity firms love EBITDA because it allows them to compare a company they want to buy against others without worrying about different tax structures or debt loads. However, critics, like Warren Buffett, hate it because it ignores the very real cost of replacing old equipment, CapEx. 5. Free cash flow, FCF. The definition: the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. The real explanation: profit is an accounting opinion. Cash is a fact. A company can show a profit on its P&L statement while actually running out of cash. Example: if they sell goods on credit but haven't been paid yet. FCF is the actual cold, hard cash left over after paying the bills and buying necessary equipment. It is the fuel for paying dividends, buying back stock, or paying down debt. Context: Amazon ran for years with low profit but massive free cash flow, which allowed them to dominate the market while looking unprofitable to the untrained eye. 6. Amortization versus depreciation. The definition: methods for expensing the cost of an asset over time. The real explanation: both concepts spread the cost of an asset over its useful life so a company doesn't take a huge financial hit in the year of purchase. Depreciation is for physical things, tangible assets. If you buy a truck for $50,000, you might expense $10,000 a year for 5 years. Amortization is for non-physical things, intangible assets. If you buy a patent for $50,000, you amortize that cost over the patent's life. Context: tech companies often have huge amortization costs due to software development and intellectual property, while manufacturing firms have heavy depreciation due to machinery. 7. Compound annual growth rate, CAGR. The definition: the mean annual growth rate of an investment over a specified period of time longer than 1 year. The real explanation: investments don't grow in a straight line. They go up 20% 1 year, down 10% the next, and up 5% the year after. CAGR smooths this volatility out to answer. If this growth had been steady and consistent every single year, what would the rate be? It is a theoretical number that describes the geometric progression ratio. Context: mutual funds use this to tell you their 5-year performance. It prevents a single lucky year from distorting the reality of the investment's long-term performance. 8. Operating leverage. The definition: a measurement of the degree to which a firm or project incurs a combination of fixed and variable costs. The real explanation: this measures how much a company's profit grows when its sales grow. High operating leverage. You have high fixed costs. Example: a software company that spends millions developing code. Once the code is written, selling 1 copy or 1 million copies costs the same. Therefore, every additional sale is almost pure profit. Low operating leverage. You have high variable costs. Example: a consultancy. To sell more, you need to hire more people. Your profit margin stays roughly the same, regardless of scale. Context: investors love high operating leverage in good times. Profits explode but hate it in bad times. Losses pile up fast because fixed costs must still be paid. 9. Capital expenditure, CapEx, versus operating expenditure, OpEx. The definition: CapEx is money spent to buy or maintain physical assets. OpEx is money spent on day-to-day operations. The real explanation: the distinction matters for taxes and cash flow. OpEx, rent, salaries, electricity, is deducted from your taxes immediately in the year it is spent. CapEx, buying a building, a server farm, cannot be fully deducted immediately. It must be depreciated over years. Context: companies often try to classify spending as CapEx to boost current profits by delaying the expense recognition. A maneuver that savvy analysts watch closely for signs of accounting manipulation. 10. Return on equity, ROE. The definition: a measure of financial performance calculated by dividing net income by shareholders' equity. The real explanation: this tells shareholders how good the company is at using their money. If I give the company $100 to buy shares, how much profit does that $100 generate? A high ROE generally means the company is efficient at using investment capital to grow. Context: high ROE can be engineered by taking on debt, since debt reduces equity in the denominator. This is why looking at ROE in isolation can sometimes be dangerous. It might mask a risky, debt-heavy balance sheet. 11. Short selling. The definition: the sale of a security that is not owned by the seller or that the seller has borrowed. The real explanation: most investing is long, buy low, sell high. Shorting is the opposite: sell high, buy low. You borrow a stock from a broker and sell it immediately at the current price, say $100. You now have $100 cash, but you owe the broker 1 share. You wait for the price to crash to $60. You buy the share back at $60, return it to the broker, and keep the $40 difference. Context: this is risky because losses are infinite. If the stock goes to $1,000 instead of dropping, you still have to buy it back, losing massive amounts of money. A short squeeze. 12. Derivatives. The definition: financial contracts that derive their value from an underlying asset. The real explanation: a derivative is a side bet. You aren't trading the actual asset like a barrel of oil or a stock. You are trading a contract based on what that asset does. It's like betting on a horse race. You don't own the horse, you own a slip of paper that has value depending on where the horse finishes. Context: used for hedging, reducing risk, or speculation, increasing risk. The 2008 financial crisis was largely fueled by complex derivatives based on mortgages. 13. Futures versus forwards. The definition: contracts to buy or sell an asset at a specific price on a future date. The real explanation: both are promises to trade later. Futures. These are standardized contracts traded on a public exchange, like the Chicago Mercantile Exchange. They are regulated and liquid. Forwards. These are private, customized agreements between two parties. OTC, over the counter. They are riskier because if the other guy goes bankrupt, you are out of luck. Counterparty risk. Context: airlines use these to lock in fuel prices. They might buy oil futures at $70 or a barrel for delivery next year. If oil goes to $100, they save millions. If it drops to $50, they overpay. 14. Options. Call versus put. The definition: contracts that give the holder the right, but not the obligation, to buy or sell an asset at a set price. The real explanation: call option. You pay a premium for the right to buy a stock at a certain price. You hope the price goes up. Put option. You pay a premium for the right to sell a stock at a certain price. You hope the price goes down. Unlike futures, you can walk away if the trade goes against you, losing only the premium you paid for the contract. Context: the Big Short guys bought puts on the housing market betting it would collapse. 15. Margin trading. The definition: borrowing money from a broker to purchase stock. The real explanation: leverage. If you have $10,000, you can borrow another $10,000 on margin to buy $20,000 worth of stock. If the stock goes up 10%, you make $2,000. Since you only put in $10,000, your actual return is 20%, double. Context: if the stock drops 10%, you lose $2,000, which is 20% of your actual money. If it drops too much, the broker issues a margin call, forcing you to deposit more cash, or they sell your stock instantly to recover their loan. 16. Arbitrage. The definition: the simultaneous purchase and sale of the same asset in different markets to profit from tiny differences in the asset's listed price. The real explanation: risk-free profit. If gold is selling for $1,000 in London and $1,005 in New York, a trader buys in London and instantly sells in NY, pocketing $5. Context: in the age of high-frequency trading, HFT computers do this in milliseconds. It keeps global markets efficient by ensuring prices are roughly the same everywhere. 17. Liquidity, market versus accounting. The definition: how easily an asset can be converted into cash without affecting its market price. The real explanation: market liquidity. Can you sell this stock right now? Apple stock is highly liquid. You can sell $1 million worth in seconds. A rare painting is illiquid. It might take months to find a buyer. Accounting liquidity. Can this company pay its bills? Measured by the current ratio, current assets, or current liabilities. Context: liquidity dries up in crises. In 2008, even valuable assets became worthless because no one had the cash to buy them at that exact moment. 18. Volatility, beta. The definition: a statistical measure of the dispersion of returns for a given security or market index. The real explanation: beta measures how much a stock moves compared to the overall market. Beta equals 1 moves exactly with the market. Beta greater than 1, more volatile, high risk or reward. Example: tech stocks. Beta 1, less volatile, defensive stocks. Example: utilities, Coca-Cola. Context: investors use beta to build a portfolio that matches their risk tolerance. 19. Hedging. The definition: making an investment to reduce the risk of adverse price movements in an asset. The real explanation: it is insurance. You don't hedge to make money, you hedge to stop from losing it. If you own a lot of stocks, you might buy a put option, see 14. If the market crashes, your stocks lose value, but your put option gains value, offsetting the loss. Context: A farmer hedges by locking in crop prices before harvest to ensure they don't go bankrupt if food prices plummet. 20. Mark-to-market, fair value accounting. The definition: assessing the value of an asset based on its current market price rather than its book value, original cost. The real explanation: if you bought a house for $200,000, but the market crashes and it's now worth $100,000, mark-to-market forces you to record the value as $100,000 immediately. This creates transparency but can cause panic spirals. Context: during financial crises, banks are forced to mark down assets to fire sale prices, which makes them look insolvent, forcing them to sell more assets, driving prices down further, a vicious cycle. 21. Credit default swap, CDS. The definition: a financial swap agreement that the seller of the CDS will compensate the buyer in the event of a debt default. The real explanation: it is insurance against someone not paying you back. If you lend money to Company X, you can buy a CDS from Bank Y. If Company X goes bankrupt, Bank Y pays you back the loan. Context: this allows speculators to bet on companies or countries failing without actually owning their debt. 22. Collateralized debt obligation, CDO. The definition: a structured financial product that pools together cash flow generating assets and repackages this asset pool into discrete tranches that can be sold to investors. The real explanation: imagine a box. You fill it with thousands of mortgages, home loans. You then slice the box into layers. Top layer, senior tranche, gets paid first. Very safe, low interest. Bottom layer, equity tranche, gets paid last. Very risky, high interest. The idea is to turn risky loans into safe investments through diversification. Context: in 2008, the safe layers turned out to be full of bad loans, toxic waste, causing the box to implode. 23. Securitization. The definition: the process of taking an illiquid asset, like a home mortgage or credit card debt, and transforming it into a security. The real explanation: banks don't want to hold your 30-year mortgage. They want their cash back now to lend to someone else. So they bundle your mortgage with thousands of others and sell the bundle to investors as a bond. The investors get the monthly mortgage payments and the bank gets immediate cash. Context: this fuels the housing market by ensuring banks always have cash to lend. 24. Yield curve, normal versus inverted. The definition: a line that plots the interest rates, yields, of bonds having equal credit quality but differing maturity dates. The real explanation: normal curve, short-term loans have low interest. Long-term loans have high interest because locking money away for 30 years is riskier or inconvenient. Inverted curve, short-term interest rates are higher than long-term rates. This is bizarre. It means investors are so scared of the near future that they are rushing to lock money away in long-term bonds for safety, driving those yields down. Context: an inverted yield curve has successfully predicted almost every recession in the last 50 years. 25. Bond duration versus maturity. The definition: maturity is when the bond expires. Duration is a measure of the sensitivity of the price of a bond to a change in interest rates. The real explanation: if you hold a bond until it matures, the price fluctuations don't matter. But if you have to sell it early, interest rates matter. Duration tells you how much the bond price will drop if interest rates rise by 1%. Context: high duration means high risk if the Federal Reserve raises rates. 26. Quantitative easing, QE. The definition: a monetary policy where a central bank purchases government securities or other securities from the market to lower interest rates and increase the money supply. The real explanation: often called printing money, but it's more digital than that. The central bank creates money out of thin air and uses it to buy bonds from banks. The banks now have a ton of cash, liquidity, that they are supposed to lend to people and businesses to jumpstart the economy. Context: used heavily after 2008 and during COVID-19. Critics argue it causes asset inflation, housing or stocks go up, and widens the wealth gap. 27. Quantitative tightening, QT. The definition, the reverse of QE. The central bank sells its assets or lets them expire to reduce the money supply. The real explanation, the central bank sucks money out of the economy. They stop buying bonds or sell the ones they have. This raises interest rates and cools down an overheated economy. Context. This is painful. It usually causes stock markets to drop and borrowing to become expensive. 28. Federal funds rate. The definition. The target interest rate set by the Fed at which commercial banks borrow and lend their excess reserves to each other overnight. The real explanation. This is the mother of all interest rates. It is the base cost of money. If the Fed raises this rate, it becomes more expensive for banks to borrow. Banks then pass this cost to you. Higher mortgage rates, credit card rates, business loans. Context. The primary tool the Fed uses to fight inflation, raise rates, or fight unemployment, lower rates. 29. Fractional reserve banking. The definition. A banking system in which only a fraction of bank deposits are backed by actual cash on hand and available for withdrawal. The real explanation. If you deposit $100, the bank doesn't keep it in a vault. They keep $10, the reserve, and lend out $90 to someone else. That person deposits the $90 in their bank, which keeps $9 and lends out $81. Context. This allows money to multiply throughout the economy, the multiplier effect. However, if everyone runs to the bank to withdraw their cash at once, a bank run, the bank collapses because the money literally isn't there. 30. Fiat currency. The definition. Government-issued currency that is not backed by a physical commodity, such as gold or silver. The real explanation. The money in your wallet has value only because the government says it does, and we all agree to believe them. It is backed by full faith and credit, not gold. Context. This gives governments flexibility to manage the economy, print money during crises, but introduces the risk of hyperinflation if they print too much. 31. Inflation. CPI versus PCE. The definition. The rate at which the general level of prices for goods and services is rising. The real explanation. CPI. Consumer Price Index. Measures a basket of goods. Milk, gas, rent. PCE, personal consumption expenditures. The Fed prefers this. It accounts for substitution. Example. If beef gets expensive, people buy chicken. CPI ignores this switch, but PCE captures it. Context. Inflation erodes your purchasing power. If your savings earn 2% interest, but inflation is 5%, you are getting 3% poorer every year. 32. Stagflation. The definition. A situation in which the inflation rate is high, the economic growth rate slows, and unemployment remains steadily high. The real explanation. The policymaker's nightmare. Usually you have inflation, hot economy, or unemployment, cold economy. Stagflation is both. If you lower rates to fix unemployment, inflation gets worse. If you raise rates to kill inflation, unemployment gets worse. Context. Famous in the 1970s, oil shocks. There is no easy fix. Usually, the economy has to suffer a deep recession to reset. 33. Hyperinflation. The definition. Rapid, excessive, and out-of-control general price increases in an economy, typically greater than 50% per month. The real explanation. A total loss of faith in the currency. People spend money the second they get it because it will be worth less in an hour. Context. Germany, Weimar Republic, Zimbabwe, Venezuela. It destroys the middle class and wipes out savings completely. 34. Deflation versus disinflation. The definition. Deflation. Prices go down. Negative inflation. Disinflation. Prices go up, but slower than before. Inflation drops from 5% to 3%. The real explanation. Deflation sounds good, cheaper stuff, but it's catastrophic. If you know a car will be cheaper next month, you wait to buy. Demand collapses, companies fire workers, workers spend less, and prices drop further. It is a deflationary spiral. Context. Japan's lost decades were defined by fighting deflation. 35. Velocity of money. The definition. The rate at which money is exchanged in an economy. The real explanation. How many times does a single dollar bill change hands in a year? If I pay you $1, and you pay the baker, and he pays the miller, That dollar created $3 of economic activity. Context: if the Fed prints trillions, high supply, but people are scared and hoard it. Low velocity. You won't get inflation. Inflation requires both money supply and money movement. Response 2 of 3, terms 3670. Part 2, macro engines and behavioral economics. 36. Fiscal deficit versus national debt. The definition: deficit, the difference between what the government earns, taxes, and spends in a single year. Debt, the accumulation of all past deficits. The real explanation: think of the deficit as your annual credit card overspending. Think of the debt as your total credit card balance. Context: governments run deficits to stimulate growth, but the interest payments on the massive national debt can eventually eat up the entire budget. 37. Crowding out effect. The definition: a situation when increased interest rates lead to a reduction in private investment spending such that it dampens the initial increase of total investment spending. The real explanation: there is a limited amount of loanable money in the world. When the government borrows huge amounts to fund the deficit, it soaks up that available cash. This leaves less money for private businesses to borrow or makes it more expensive for them. Context: large government spending can accidentally hurt the private sector by hogging all the available capital. 38. Purchasing power parity, PPP. The definition: an economic theory that compares different countries' currencies through a basket of goods approach. The real explanation: the Big Mac Index. If a Big Mac costs $5 in the US and $4 in the UK, the exchange rate should be 1.25. If the actual exchange rate is different, one currency is overvalued or undervalued. It measures what money can actually buy locally, rather than just the exchange rate. Context: this explains why someone earning $20,000 in India might have a better standard of living than someone earning $40,000 in New York. 39. GDP, gross domestic product, versus GNP, gross national product. The definition: GDP, everything produced within a country's borders, regardless of who owns the factory. GNP, everything produced by a country's citizens, regardless of where they are in the world. The real explanation: Toyota manufacturing cars in Alabama counts toward US GDP, location-based. Toyota manufacturing cars in Alabama counts toward Japanese GNP, ownership-based. Context: GDP is the standard for measuring economic health, but GNP is useful for understanding how much wealth actually stays with the country's people. 40. Opportunity cost. The definition: the loss of potential gain from other alternatives when one alternative is chosen. The real explanation: the cost of something is not just the money you pay, but what you gave up to get it. If you go to grad school, the cost isn't just tuition, it's also the 2 years of salary you did earn by working. Context: this is the foundation of all economic decision-making. Is this the best possible use of my limited resources? 41. Sunk cost fallacy. The definition: the phenomenon whereby a person is reluctant to abandon a strategy or course of action because they have invested heavily in it, even when it is clear that abandonment would be more beneficial. The real explanation: throwing good money after bad. You spent $100M on a project that is failing. Rational logic says, stop now. Sunk cost logic says, we can't stop. We already spent $100M. Context: the Concorde jet was a financial disaster, but governments kept funding it for years because they had already spent so much. 42. Comparative advantage. The definition: the ability of an individual or group to carry out a particular economic activity, such as making a specific product, more efficiently than another activity. The real explanation: even if country A is better than country B at making everything, they should still trade. Country A should focus on what it is most amazing at, and let country B do the stuff country A is only moderately good at. Context: this is the mathematical proof for why free trade generally makes the world richer, even if it hurts specific industries. 43. Elasticity, price elasticity of demand. The definition: a measure of the responsiveness of the quantity demanded of a good to a change in its price. The real explanation: inelastic, you need it to survive. Example: insulin, water. If the price doubles, you still buy it. Elastic, it's a luxury. Example: movie tickets. If the price doubles, you stop buying it. Context: businesses crave inelastic products because they have pricing power. They can raise prices without losing customers, like Apple or cigarettes. 44. Marginal utility. The definition: the additional satisfaction a consumer gains from consuming one more unit of a good or service. The real explanation: the first slice of pizza is heaven. The second is good. The fifth makes you sick. The value of things drops the more you have of them, diminishing marginal utility. Context: this explains why demand curves slope downward. You are willing to pay less for the second unit than the first. 45. Economies of scale. The definition: cost advantages reaped by companies when production becomes efficient. The real explanation: bigger is cheaper. If you make 100 chairs, you buy wood at retail price. If you make 1 million chairs, you buy the whole forest. Your cost per unit drops drastically as you get bigger. Context: this is why Walmart and Amazon destroy small businesses. They can operate on razor-thin margins that would bankrupt a small competitor. 46. Externalities, positive and negative. The definition: a cost or benefit caused by a producer that is not financially incurred or received by that producer. The real explanation: negative externality. A factory pollutes the air. The factory makes profit, but the neighbors pay the cost and health issues. The market price of the product doesn't reflect the pollution costs. Positive externality: you get vaccinated. You are safe, but you also protect your neighbors. Context: governments use taxes, carbon tax, to force companies to internalize these externalities. 47. Public goods, non-excludable and non-rivalrous. The definition: a commodity or service that is provided without profit to all members of a society. The real explanation: the free market fails here. Non-excludable: you can't stop people from using it. Example: streetlights. Non-rivalrous: one person using it doesn't leave less for others. Example: national defense. Context: because you can't charge people individually for streetlights, the free rider problem. The government must provide them using tax money. 48. Tragedy of the commons. The definition: a situation in a shared resource system where individual users acting independently according to their own self-interest behave contrary to the common good of all users by depleting that resource. The real explanation: if there is a public park where anyone can graze their sheep, everyone adds just one more sheep to maximize their own profit. Eventually, the grass is destroyed and everyone's sheep die. Context: overfishing, pollution, and climate change are classic examples. Individual greed destroys the collective resource. 49. The invisible hand. The definition: the unobservable market force that helps the demand and supply of goods in a free market to reach equilibrium automatically. The real explanation: Adam Smith's theory. By pursuing their own selfish interests, the baker bakes bread to make money, not to be nice. Individuals accidentally create a society that benefits everyone. Context: the foundational argument for capitalism that decentralized, selfish actions lead to better outcomes than centralized planning. 50. Creative destruction. The definition: process of industrial mutation that incessantly revolutionizes the economic structure from within, incessantly destroying the old one, incessantly creating a new one. The real explanation: innovation hurts. For the car to exist, the horse and buggy industry had to die. For Netflix to rise, Blockbuster had to fail. Economic progress is a messy process of destroying old, inefficient industries to replace them with new, efficient ones. Context: Joseph Schumpeter's concept explains why trying to save dying industries like coal or typewriters often holds back economic growth. 51. Nash equilibrium. The definition: a concept in game theory where the optimal outcome of a game is one where no player has an incentive to deviate from their chosen strategy after considering an opponent's choice. The real explanation: it's a stalemate of strategy. Imagine two rival companies setting prices. If Company A lowers prices, Company B must lower prices to survive. Eventually, both hit a price where neither can lower it further without going bankrupt. but neither can raise it without losing customers to the other. They are stuck. This stuck point is the Nash equilibrium. Context: used to analyze nuclear deterrence, mid-mutually assured destruction, and oligopolies, why Coke and Pepsi have similar prices. 52. The prisoner's dilemma. The definition: a paradox in decision analysis, in which two individuals acting in their own self-interests do not produce the optimal outcome. The real explanation: two criminals are arrested. If both stay silent, they get 1 year in jail. If one betrays the other, the betrayer goes free, and the silent one gets 10 years. If both betray, they both get 5 years. Rationally, both should stay silent. But because they can't trust each other, they both betray and get 5 years. Rational individual choice leads to a terrible collective outcome. Context: this explains why nations struggle to agree on climate change treaties. Everyone wants to pollute, betray, while others clean up, stay silent. 53. Moral hazard. The definition: a situation where an economic actor has an incentive to increase its exposure to risk because it does not bear the full costs of that risk. The real explanation: if you have full car insurance with $0 deductible, you might drive more recklessly because the insurance will pay for it. You engage in risky behavior because you are insulated from the consequences. Context: the too-big-to-fail banks in 2008 took massive risks because they knew the government, taxpayers, would bail them out if they failed. 54. Asymmetric information, the lemon's problem. The definition: a situation where one party to an economic transaction possesses greater material knowledge than the other party. The real explanation: the seller of a used car knows if it's a lemon, broken. The buyer does not. Because the buyer knows they might get ripped off, they refuse to pay a high price. This drives sellers of good cars out of the market. Why sell a good car for a low price? Eventually the market collapses, and only bad cars are left. Context: this is why health insurance is expensive. Sick people know they need it and buy it, while healthy people avoid it. 55. Principal agent problem. The definition: a conflict in priorities between a person or group and the representative authorized to act on their behalf. The real explanation: the principal, shareholder, wants a stock price to go up long term. The agent, CEO, wants a big bonus this year. The CEO might slash R&D or fire workers to boost short-term profits, getting their bonus, while destroying the company's long-term future. Their interests are misaligned. Context: stock options, vesting over years, are an attempt to fix this by forcing the agent to care about the long-term price. 56. Adverse selection. The definition: a situation where sellers have information that buyers do not, or vice versa, about some aspect of product quality. The real explanation: similar to asymmetric information, but specifically regarding who participates in a market. If an insurance company offers life insurance at an average price, the only people who will buy it are those who expect to die soon. Smokers, stuntmen. The average person won't buy it because it's too expensive for them. The insurer is left with only the worst risks. Context: this is why insurance is often mandatory, like auto insurance, to force healthy or safe people into the pool to subsidize the risky ones. 57. The winner's curse. The definition: a phenomenon that may occur in common value auctions, where the winner of the auction tends to overpay for the good. The real explanation: if 10 oil companies bid for a drilling site, the average bid is likely the true value. The winner is the one who bid the highest, meaning they were the most optimistic and probably wrong about how much oil is there. Winning the auction is actually a loss because you paid more than the asset is worth. Context: common in corporate mergers and acquisitions, M&A. The buying company's stock often drops because investors assume they overpaid. 58. Prospect theory, loss aversion. The definition: a theory that people value gains and losses differently, and, as such, will base decisions on perceived gains rather than perceived losses. The real explanation: losing $100 hurts twice as much as finding $100 feels good. We are irrational. We will take huge risks to avoid a loss, but we will settle for small, sure gains. Context: investors hold on to losing stocks for years, hoping it comes back, but sell winning stocks too early, locking in the win. 59. Anchoring bias. The definition: the tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. The real explanation: if I show you a $5,000 watch first, then a $500 watch, the $500 watch seems cheap. If I showed you a $50 watch first, the $500 watch would seem expensive. The value hasn't changed, only your reference point. Context: salary negotiations. The first number thrown out sets the anchor. If you ask for $100,000, the negotiation happens around $100K60. Hyperbolic discounting. The definition: the tendency for people to increasingly choose a smaller, sooner reward over a larger, later reward, as the delay occurs sooner rather than later. The real explanation: we are terrible at delaying gratification. Would you prefer $100 today or $110 in a month? Most say $100 today, but if asked $100 in a year or $110 in a year in a month, most say the latter. We are impatient in the present but patient in the future. Context: why people fail to save for retirement. The pain of saving today is real, the pleasure of retirement is abstract. 61. The endowment effect. The definition: the hypothesis that people ascribe more value to things merely because they own them. The real explanation: you might pay $5 for a coffee mug, but once you own it, you wouldn't sell it for less than $10. Ownership creates an emotional attachment that distorts value. Context: this makes housing markets sticky. Sellers think their home is worth way more than buyers do, leading to standstills. 62. Nudge theory. The definition: a concept which proposes positive reinforcement and indirect suggestions as ways to influence the behavior and decision-making of groups or individuals. The real explanation: you don't force people, you make the right choice easier. Putting fruit at eye level in a cafeteria and junk food on the bottom shelf is a nudge. People still have free will, but they are statistically more likely to pick the fruit. Context: opt-out organ donation policies, where you are automatically a donor unless you say no, have drastically higher participation than opt-in policies. 63. Sunk cost fallacy, revisited and deepened. The definition: continuing a behavior or endeavor as a result of previously invested resources, time, money, or effort. The real explanation: rationally, past costs are irrelevant to future decisions. Only future costs or benefits matter. If you buy a movie ticket for $15 and the movie is terrible, leaving after 10 minutes is the rational choice. You save 2 hours. Staying to get your money's worth is irrational. You've already lost the money. Now you're losing your time too. Context: governments continuing wars or projects so the soldiers didn't die in vain. 64. Herd behavior. The definition: the behavior of individuals in a group acting collectively without centralized direction. The real explanation: FOMO, fear of missing out. If everyone is buying Bitcoin, you assume they know something you don't, so you buy it too. This creates asset bubbles. Context: stock market crashes are often heard stampeding for the exit, regardless of the actual value of the companies. 65. Confirmation bias. The definition: the tendency to search for, interpret, favor, and recall information in a way that confirms or supports one's prior beliefs or values. The real explanation: if you think a stock will go up, you only read the positive news articles about it and ignore the warnings. You are blinding yourself to reality. Context: echo chambers in media and finance. 66. Pareto efficiency. Pareto optimality. The definition: a state of allocation of resources from which it is impossible to reallocate, so as to make any one individual or preference criterion better off without making at least one individual or preference criterion worse off. The real explanation: it's the perfect efficiency but not necessarily fair. If I have all the money and you have none, that is Pareto efficient, because giving you $1 would make me worse off. Context: economics focuses on efficiency, growing the pie. Politics focuses on equity, slicing the pie. Response 3 of 3. Terms 67,100. Part 3. Advanced macro, inequality and risk metrics. 67. The Cobra effect. The definition: when an attempted solution to a problem makes the problem worse due to unintended consequences. The real explanation: the British government in India wanted to reduce cobra populations, so they offered a bounty for dead cobras. People started breeding cobras to kill them and collect the bounty. When the government realized this and canceled the program, the breeders released the cobras, increasing the population. Context: policy backfires. Rent control is meant to help the poor, but it often reduces the supply of housing, making it harder for the poor to find homes. 68. The Gini coefficient. The definition: a measure of statistical dispersion intended to represent the income inequality or wealth inequality within a nation or any other group of people. The real explanation: a score between 0 and 1. 0. Perfect equality, everyone has the same income. 1. Perfect inequality, one person has all the income. Context: Nordic countries are around 0. 25. The US is around 0. 48. South Africa is around 0. 63. High Gini scores often predict social unrest. 69. The Phillips curve. The definition: an economic concept developed by A.W. Phillips, stating that inflation and unemployment have a stable and inverse relationship. The real explanation: you can't have it all. Low unemployment means people have money, they spend it, prices go up, inflation. High unemployment means people are broke, prices drop, deflation. Governments must trade one off against the other. Context: this relationship broke down in the 1970s, stagflation, but central banks still use it as a rough guide. 70. Okun's law. The definition: an empirically observed relationship between unemployment and losses in a country's production. The real explanation: for every 1% increase in the unemployment rate, a country's GDP will be roughly 2% lower than its potential GDP. Context: unemployment isn't just a social tragedy, it's a massive waste of economic potential. Empty factories and idle workers mean wealth that could have been created wasn't. 71. The Laffer curve. The definition: a theoretical relationship between rates of taxation and the resulting levels of government revenue. The real explanation: if you tax at 0%, the government gets $0. If you tax at 100%, nobody works, so the government gets $0. Somewhere in the middle, the peak of the curve, is the optimal tax rate that maximizes revenue. Context: used by supply-side economists, Reaganomics, to argue that cutting taxes can actually increase government revenue by stimulating growth. The debate is: where is the peak? 30%, 70%, 72. Ricardian equivalence. The definition: an economic theory that suggests when a government tries to stimulate an economy by increasing debt-financed government spending, demand remains unchanged. The real explanation: rational people know that government debt equals future taxes. If the government gives you a stimulus check funded by debt, you should save it to pay the future taxes, rather than spending it. Therefore, the stimulus fails. Context: in reality, people aren't this rational. They spend the check, but it explains why stimulus impacts can be muted. 73. The liquidity trap. The definition: a situation in which interest rates are low and savings rates are high, rendering monetary policy ineffective. The real explanation: the Fed lowers interest rates to 0% to encourage spending. But people are so scared of the future that they hoard cash anyway. The Fed is pushing on a string. No matter how much money they print, it doesn't move. Context: Japan in the 1990s. The only way out is often massive government spending, fiscal policy, rather than central bank tinkering, monetary policy. 74. Zero lower bound, ZLB. The definition: a macroeconomic problem that occurs when the short-term nominal interest rate is at or near zero, causing a liquidity trap and limiting the capacity that the central bank has to stimulate economic growth. The real explanation: interest rates generally can't go below zero. Why would I lend you $100 to get $98 back? Once rates hit 0%, the central bank is out of ammo. Context: this forced central banks to invent unconventional tools like quantitative easing, QE, because their conventional tool, rates, was broken. 75. Fiscal multiplier. The definition: the ratio of a change in national income to the change in government spending that causes it. The real explanation: If the government spends $1 billion building a bridge, the construction workers get paid. They spend that money at restaurants. The restaurant owners pay farmers. That initial $1 billion might create $1. 5B in total GDP. The multiplier is 1. 5. Context. The debate is usually, is the multiplier greater than 1? If it's less than 1, example, 0. 8. Government spending actually destroys wealth. 76. Automatic stabilizers. The definition, mechanisms built into government budgets without any additional legislative action, which increase spending or decrease taxes when the economy slows. The real explanation, unemployment insurance and progressive income tax. When the economy crashes, people lose jobs. They automatically get unemployment checks, stimulus. They pay less tax. This cushions the blow without Congress having to pass a new law. Context. These prevent mild recessions from becoming Great Depressions. 77. Hysteresis. The definition, the dependence of the state of a system on its history. The real explanation, in economics, it means a recession leaves permanent scars. If a worker is unemployed for 2 years, they lose skills and motivation. Even when the economy recovers, that worker is unemployable. The economy doesn't bounce back to where it was at, settles at a lower level. Context. A strong argument for acting fast and hard during a crisis to prevent long-term damage. 78. Dutch disease. The definition, the apparent causal relationship between the increase in the economic development of a specific sector, for example natural resources, and a decline in other sectors, like the manufacturing sector or agriculture. The real explanation, a country discovers oil. Foreigners rush to buy the oil, driving up the value of the country's currency. Now, that country's other exports, cars, corn, are too expensive for the rest of the world to buy. The manufacturing sector dies, and the country becomes 100% dependent on oil. Context. Happened to the Netherlands, gas, Venezuela, oil, and potentially Australia, mining. 79. The impossible trinity, trilemma. The definition, a concept in international economics, which states that it is impossible to have all three of the following at the same time: a fixed foreign exchange rate, free capital movement, and an independent monetary policy. The real explanation, you can only pick 2. Option A, USA. Free capital plus independent policy equals volatile exchange rate. Option B, China. Fixed exchange plus independent policy equals closed capital borders. You can't easily move money out. Option C, Eurozone. Fixed exchange plus free capital equals no independent policy. Greece must do what the ECB says. Context. Countries often try to have all three and end up in a currency crisis. 80. Balance of payments. Current versus capital account. The definition, the record of all economic transactions between the residents of the country and the rest of the world. The real explanation, it must sum to 0. Current account, trade of stuff, exports, imports. If you buy more than you sell, deficit. You need to pay for it. Capital account, trade of assets, stocks, bonds, land. You pay for the trade deficit by selling your assets to foreigners. Context. The U.S. runs a huge trade deficit, buys stuff, but runs a huge capital surplus. Foreigners buy U.S. stocks or bonds. 81. Value at risk, VAR. The definition, a statistic that quantifies the extent of possible financial losses within a firm, portfolio, or position over a specific time frame. The real explanation, what is my worst-case scenario on a normal bad day? A 95% one-day VAR of $1 million means we are 95% sure we won't lose more than $1M tomorrow. But that implies 5% of the time, or once a month, you will lose more than that. Context. VAR failed in 2008 because it relies on historical data. It didn't predict black swan events that had never happened before. 82. The Sharpe ratio. The definition, a measure for calculating risk-adjusted return. The real explanation, return is easy. Risk is hard. If Fund A makes 10% and Fund B makes 10%, are they equal? No. If Fund A took crazy gambling risks to get that 10%, while Fund B played it safe, Fund B is better. Sharpe ratio divides return by volatility. Higher is better. Context, the gold standard for evaluating hedge funds. 83. The Sortino ratio. The definition, a variation of the Sharpe ratio that differentiates harmful volatility from total overall volatility. The real explanation, volatility isn't always bad. If a stock shoots up 20%, that's volatile, but investors love it. Sharpe punishes all volatility. Sortino only punishes downside volatility, losing money. Context, a more accurate measure for investors who don't care if the price jumps up, only if it crashes. 84. Alpha versus beta. The definition, beta, the return you get from the market, passive. Alpha, the return you get above the market due to skill, active. The real explanation, if the market goes up 10% and your portfolio goes up 12%, your alpha is 2%. You beat the market. Investors pay high fees for alpha. Context, it is incredibly hard to generate consistent alpha. Most active managers fail to beat the S&P 500 over time. 85. The efficient market hypothesis, EMH. The definition, an investment theory that states it is impossible to beat the market because stock market efficiency causes existing share prices to always incorporate and reflect all relevant information. The real explanation, the market knows everything. If a stock is undervalued, millions of traders would have already bought it, driving the price up. Therefore, picking stocks is gambling. You should just buy the whole index. Index funds. Context, Warren Buffett disagrees. He believes markets are irrational and emotional, leaving room for smart pickers. 86. Random walk theory. The definition, the theory that stock price changes have the same distribution and are independent of each other. The real explanation, past movement does not predict future movement. Just because a stock went up yesterday doesn't mean it will go up today. Analyzing charts, technical analysis, is like reading tea leaves. Context, supports the strategy of buy and hold rather than day trading. 87. Black-Scholes model. The definition, a mathematical model for pricing an options contract. The real explanation, before this, nobody knew what an option C14 was truly worth. This formula uses the stock price, time until expiration, volatility, and interest rates to calculate the fair price. It legitimized the derivatives market. Context, it's brilliant but assumes markets are frictionless and continuous, which they aren't during a crash. 88. The Greeks, delta, gamma, theta. The definition, dimensions of risk involved in taking an options position. The real explanation, delta, how much the option price moves for every $1 move in the stock. Theta, time decay. Options lose value every day as they get closer to expiration. Theta measures this bleeding. Gamma, the rate of change of delta, acceleration. Context, professional traders don't trade stocks. They trade volatility using these metrics to hedge precisely. 89. R squared, coefficient of determination. The definition, a statistical measure that represents the proportion of the variance for a dependent variable that's explained by an independent variable. The real explanation, how much does this stock act like the market? R squared equals 100. It moves exactly in lockstep with the index. Example, an index fund. R squared equals 0. It moves completely randomly compared to the index. Context, used to determine if a mutual fund is actually active or just a closet index fund charging high fees for doing nothing. 90. Correlation versus causation. The definition, correlation, a statistical measure that indicates the extent to which two or more variables fluctuate together. Causation, the capacity of one variable to influence another. The real explanation, ice cream sales and shark attacks are highly correlated, both go up in summer. But eating ice cream doesn't cause shark attacks. Context, algorithmic trading computers often find correlations that make no sense, spurious correlations, and trade on them, sometimes leading to disaster. 91. Capitulation. The definition, when investors give up any previous gains in any security or market by selling their positions during declining periods. The real explanation. The puke point. Investors hold on during a crash, hoping it recovers. Finally, the pain becomes too much, and they sell everything just to stop the stress. Context. Ironically, capitulation usually marks the bottom of the market. Once everyone who wants to sell has sold, the only direction left is up. 92. Dead cat bounce. The definition: a temporary recovery in share prices after a substantial fall. The real explanation: even a dead cat will bounce if it falls from a great height. After a massive crash, traders cover their short positions, buy back stock, causing a brief rally. It looks like a recovery, but then the price drops even lower. Context: a trap for optimistic investors who buy the dip too early. 93. Fungibility. The definition: the property of a good or a commodity whose individual units are essentially interchangeable. The real explanation: a dollar bill is fungible. If I borrow your dollar and give you back a different dollar, you don't care. A house is non-fungible. If I borrow your house and give you a different house, you do care. Context: crypto, NFTs, non-fungible tokens, is based on creating unique digital items that cannot be swapped like Bitcoin. 94. Gresham's Law. The definition: bad money drives out good. The real explanation: if there are two currencies in circulation and one is made of pure gold, good, and one is made of paper, bad, people will hoard the gold and spend the paper. The good money disappears from circulation. Context: why silver coins disappeared from the US when they stopped making them in 1964. People kept the silver and spent the new copper or nickel coins. 95. The J-curve effect. The definition: a trend line that shows an initial loss immediately followed by a dramatic gain. The real explanation often applies to currency devaluation. If a country lowers its currency value, exports should get cheaper and increase. But initially, they get more expensive because contracts are already signed. The trade deficit gets worse, the dip in the J, before it gets better, the rise in the J. Context explains why economic reforms often feel like they are failing before they succeed. 96. Moral suasion, jawboning. The definition: the attempt to coerce others into a certain behavior by using rhetorical appeals, implicit threats, or appeals to altruism. The real explanation: the Fed chairman goes on TV and says, "We are watching inflation closely. He hasn't actually raised rates, but the threat scares markets into behaving. It's ruling by voice rather than action." Context: central bankers talk a lot to avoid having to actually do painful things. 97. Rent seeking. The definition: the practice of manipulating public policy or economic conditions as a strategy for increasing profits. The real explanation: making money without creating value. Lobbying the government to give your company a subsidy or suing a competitor to block them is rent seeking. You get a bigger slice of the pie, but you didn't make the pie bigger. Context: a massive drain on economic efficiency. 98. Regulatory capture. The definition: a form of government failure which occurs when a regulatory agency created to act in the public interest instead advances the commercial or political concerns of special interest groups that dominate the industry or sector it is charged with regulating. The real explanation: the people regulating the banks are usually ex-bankers. They are friends with the people they regulate. Eventually, the watchdog starts protecting the wolves. Context: the FDA, FAA, and SEC are often accused of being too cozy with the industries they police. 99. Survivorship bias. The definition: the logical error of concentrating on the people or things that made it past some selection process and overlooking those that did not, typically because of their lack of visibility. The real explanation: Steve Jobs dropped out of college and became a billionaire, so I should too. You are looking at the one survivor and ignoring the millions of dropouts who are broke. Context: in finance, mutual fund data is biased because the bad funds shut down and disappear from the database, making the average fund look better than it really is. 100. Utility function. The definition: a mathematical representation of consumer preferences. The real explanation: the ultimate why. Why do you buy X instead of Y? Economics assumes you have a hidden formula in your head that calculates utility, happiness, or satisfaction. You unconsciously maximize this function constantly. Context: the foundation of microeconomics. It assumes humans are rational happiness maximizing machines, which, as behavioral economics shows, is debatably true. Concluding note: these 100 terms move from the mechanics of counting money, accounting or valuation, to the mechanics of moving money, markets, to the psychology of risking money, behavioral or game theory, and finally, to the systems that govern money, macro or policy. Mastery of these concepts allows you to look at a news headline, Fed hikes rates, yield curve inverts, company X beats earnings but stock drops, and understand the invisible machinery grinding underneath.